Hello, and welcome to another episode of Perspectives. I'm Phil Gioia, product specialist here at DoubleLine, and I'm joined today by Ryan Kimmel, analyst on our macro asset allocation team. Ryan, thanks for joining the show today.
Thanks for having me.
So I brought Ryan on today because he recently wrote a paper titled U.S. Debt Spiral Watch, a Scenario Survey as Washington Drifts Towards a Reckoning. Ryan, that doesn't sound good. But the good news is that Ryan and his team have done a lot of research on this topic, and it's something that you wrote a paper about last year and something that Jeffrey Gundlach has been talking a lot about in media recently. So I wanted to bring you on the show today to talk about, what you wrote in the paper, what your team has been researching over the past few years, and let our viewers know, is it really as scary as the title might suggest?
Yeah, so, again, thanks for having me. And you're right, yeah. So we originally conducted this analysis back in the fall of last year. And what we did was we ran a scenario analysis on federal deficit spending and how that feeds through into the federal debt loads based on different interest rates and primary deficit scenarios. And the key takeaway from that analysis was that if we're in this structurally higher rate environment over the next, say, decade or so, we get to levels on the federal debt that are become increasingly worrisome. In fact, we get there a lot faster than many analysts had forecast, previous to the pandemic. So since we produced that piece in the fall last year, we've seen a number of prominent institutions come out issuing their own warnings. We had the Congressional Budget Office, the CBO, as well as the IMF come out with their warnings. And given that we're in the midst of the US election cycle and it doesn't appear like either political party is really focusing on the fiscal dynamic right now, we thought it was pretty important to bring it back up and put it in front of investors.
So growing fiscal deficit, this is something that we've seen in the past, right? It's not something that's new, but perhaps what is new this time around is the US budget deficit is expanding at the same time the economy is expanding, right? Typically or historically, what you've seen is the deficit expand during times of economic weakness. But again, for the last 4 years or 4+ years, we've seen a relatively strong economy. We've seen really record low unemployment, but at the same time, that deficit has been expanding. So can you talk a little bit about what's been causing that divergence from the norm?
Yeah, so you're right. So typically speaking, during economic expansions, you tend to see deficits decrease. And that is on the premise that, the economy is in expansion, that it leads to higher government revenues. The lower unemployment leads to lower outlays from smaller benefits for unemployment insurance. And then the reverse takes effect when you're in recessionary scenarios. You have negative GDP, lower government revenues, higher unemployment, higher unemployment insurance claims leading to higher outlays, and you see a widening of the deficit spending. And then on top of that, you have any legislative action, that from a stimulative perspective, which we saw massive stimulus post-COVID. And what we're seeing now, though, is that, we're 4 years into this expansion and the deficit levels are almost around 6% of GDP. And what's leading to that are kind of two factors. One is that mandatory spending, so think of like Social Security, Medicare and Medicaid, those have been structurally increasing over the last, say, 10 years. And then importantly, and this is more, I think, related to this cycle, is that interest expense on government debt is increasing at a pretty dramatic clip, and that's just based on the combination of higher interest rates, higher debt loads, and that's leading to a net larger outlays and higher deficits. To put in perspective, government interest expense as a share of GDP in the pre-pandemic era averaged around like 1.5% of GDP. Now for this year, it's expected to be around 3%. So there alone is 1.5% of GDP going towards interest expense, which is the crux of kind of the dynamic that we highlight in the paper.
Yeah, certainly. And as fixed income investors here at DoubleLine, right, we're very keen at watching interest rates because it drives a lot of, different performance metrics for fixed income. And I think in the paper that you alluded to, some scenarios that the CBO had laid out, they're, looking forward-looking expectations of interest rates. Could you talk about, how those projections align with the analysis or some of the work that you've done, and how they may differ?
Yeah, sure. So the whole premise of the paper was really to highlight that the level of interest rates or the interest rate environment that you go in is very impactful on your projections, and it's very sensitive. So currently, based on the CBO's last economic update, which I think came out in May of this year, they project the average interest rate on government debt outstanding to remain around 3.5%. And that would lead to government expense or interest expense on government debt outstanding to be around 23% of tax revenues. Now, I would consider that 3.5% interest rate to be a bit optimistic, especially considering that the entire Treasury curve right now is above that level, with the front end at over 5% still. So when you apply different interest rates, so say interest rates average 5% over the next 10 years, that same measure, so government interest expense as a percent of tax revenue, would climb to 35%. And if interest rates average around 6% over the next 10 years, that number goes to 45%. So almost half of tax revenue is going towards servicing the debt.
So you talked about a few different scenarios and how our analysis might differ from what the CBO is projecting. But thinking back to the title, right, how does that debt spiral come into play?
Yeah, so the whole situation becomes this like self-perpetuating negative feedback loop where higher interest expense lead to higher government debt loads, which leads to higher government borrowing, which then crowds out private investment, which then feeds through into lower potential GDP. And then the implications of that are lower potential GDP means lower government revenues, which then feeds through back into higher deficits. And you can see how the cycle then repeats and feeds in on itself.
So higher interest expense, growing deficits, potentially a crowding out of private investment, lower GDP. That all sounds pretty spooky, Ryan. Maybe you can give our viewers some hope. What are some potential paths to improvement or potential paths to a more balanced budget?
Yeah, so there's a few ways out of this dilemma that we're in. And we've actually been here in the past. So following World War II, we had similar debt loads. And, in the mid-1940s, I think debt to GDP was around like 105% of GDP. And what saved us out of that environment and how we basically worked our way out of that was that we manufactured 6% nominal growth over the following 20 years. And that was combined with interest rates being capped at around 3%. So that combination of strong nominal growth with low interest rates allowed us to work our debt from being over 100% down to around 45% over 20 years. So, do we have that luxury this time around? Well, perhaps, the integration of artificial intelligence could, increase potential GDP. I think there are a lot of unknowns there. And then you have the interest rate side of the equation, which I think the Fed has, most of the control over. And, the path to which they're starting to, worry about the level of interest rates might be a bit volatile. But, back in the 1940s, they implemented yield curve control, where they essentially capped the yield curve around a certain level. I think it was like 2.5% back then, and that lowered the interest expense and allowed, kind of the nominal GDP growth to work its way out. So your denominator is growing, and so your debt to GDP levels start to fall. Recently, we've seen the Bank of Japan. They've implemented yield curve control. They started in 2016. They've done pretty dramatic measures where the BOJ now holds 50% of Japanese government bonds outstanding. So they're essentially like implicitly monetizing, Japan's debt, which now stands like 250% of GDP. But there's been like one key kind of side effect of that policy, and that's the Japanese yen has declined rather precipitously since they embarked on this yield curve control. So perhaps, if we embarked on something like that in the US, the dollar may come under pressure.
So you gave a few scenarios of what policymakers could potentially do, but let me ask this question. Have policymakers just thought about not spending as much?
It doesn't seem like it. I mean, neither political party is really focusing on the fiscal dynamics at the moment. You have an extension of tax cuts being talked by the Republicans, and then the Democrats, they just want to increase spending. Perhaps some of the the talk of raising tariffs might offset some of that spending, but still it doesn't seem like there is too much political appetite to really take a strong look at entitlement reform and tax reform, which is what you really need to address the issue.
It sounds like the two avenues are tax and spend and borrowing spend, but both those scenarios we're spending more.
Yeah, it's not an issue until it is.
But it sounds like there could be broader implications for other financial assets. So for viewers that are investors in financial markets, perhaps you could talk a little bit about just the broader potential financial implications, and also how investors should be thinking about asset allocation with such a kind of reckoning potentially looming.
I'd say the key feature of this dynamic, though, is like the timing is very difficult. Like markets may start to care about this next week, or it could take a decade before it actually starts to matter. So you really have to take that into consideration. But the way we're looking at it is, I think it means that we're going to see structurally higher interest rates, particularly on the long end, as the federal debt loads grow and the markets become a bit more concerned about how the government is going to fund itself. I think you're going to start to see more term premium being baked into the long end. So that should lead to steeper yield curves in the U.S. Another, I think, interesting trade, which I kind of hinted on earlier, was I think that the dollar will likely sell off if the Fed starts to talk about yield curve control or capping interest rates in some form or another, because what that would imply is that real rates would become pretty significantly negative, because your nominal rate is going to be below inflation. So that would have a negative impact on the dollar versus other currencies. And then that would feed through into stronger gold, which benefits from negative real rates and a selling off of the dollar.
So it sounds like you want to be active, or at least be aware of how much interest rate risk you're taking, and also where on the curve you're taking that risk. It sounds like there could be potentially some volatility in FX, mainly the dollar, and potentially also look at some hard assets like gold. So a diversified portfolio, but overall very active. But to your point, right, it's very hard to predict when something like this will take place in the market, right, and when the market will start caring about it. So, but Ryan, this has been great. Really appreciate the time. For viewers that haven't read the paper and would like to read more, a link can be found in the video description below. And if you'd like to see more of DoubleLine's content, please visit our website, DoubleLine.com. And if you have any questions about this topic or any other topics that are top of mind for you and your clients as we head into the dog days of summer, please reach out to fundinfo@doubleline.com. Ryan, thanks again for joining. Thank you all for watching, and I hope you all enjoy the rest of your summer.